All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser, and hater of trash investing advice on YouTube. Now today, we're going to talk about the new and upstart channel called Everything Money. Now, you may think, since I hate on a bunch of other people, that I hate this channel. I actually don't. I actually think they make fantastic material. I think if you're going to watch anybody, besides me, of course, to learn how to invest for the long run and you want to play with individual stocks, this is the channel to subscribe to. They actually have excellent explanations of how to actually analyze companies, project future cash flows, and they'll generally set you up for success. And I don't believe they charge that much for their Patreon and their software. However, I think there is a big flaw in their approach, which is to buy a bunch of individual stocks, using whatever metrics they use, and I'm not saying they're bad. I actually believe in the long run, a portfolio like theirs will outperform if it's in a tax-advantaged account. But the major flaw in their approach, and basically proof of why it's so hard to beat the market if you're buying and selling individual stocks, is because of taxation. Now, one of the hosts, his name is Seth, he had his 1 year anniversary where he used I think it's the little book that beats the market. I haven't read the book, but he used that book and the software to basically buy a bunch of stocks that he believes will outperform the market. And according to what he did, according to his performance, he did beat the S&P 500, which is great. But the big problem is that if you factor in taxes after you sell your stocks at the end of every year, even if they're preferential capital gains tax rates, you're still going to underperform the market in the long run. Taxes are huge. Now let's watch a little bit of this video where he actually addresses the issue of taxation and how that can hurt your portfolio returns. So let's watch.
Be spending my $250K and my wife's $100K. And if you want to get on the train for July 1st, that's what, greetings from Germany. Great. GME is on the list. Who said that? Ian Solari. Go ahead.
Relating to buying the stocks on Thursday, here's a question from Gianni. Why are you buying them now? Is it because you hold them for 1 year?
Right, yeah.
All right, so he's at the year point. He bought a bunch of stocks a year ago, and now he's at the point where he can sell his stocks at a long-term capital gain, which is smart, because if you listen to idiots like Meet Kevin or Stock Mo or Jeremy LaFufu or whatever, you're probably buying and selling securities and paying short-term capital gains rates. At least these guys are smart enough to factor in taxation. So let's keep watching.
Guys, this is confusing a bit. So if this was just a general brokerage account, you open an account on Fidelity, you put money in it. Obviously, if you're trading with Mo and you get income, you'll have to pay taxes on that. There are different tax implications.
Wow.
There are different tax rules if you hold a stock under 1 year and over 1 year.
Yes, the government wants to incentivize you to hold stocks for the long term. So if you hold a stock for less than a year, you're going to pay tax on whatever gain you have at your marginal rate. So if you're in the 22% tax bracket or 24 or whatever you're in, if you sell a stock in less than a year, that gain gets added to your adjusted gross income, and you're going to pay taxes at your highest marginal rate. And on top of that, your state, if they have an income tax, will also tax you. So these guys are smart, and they understand that if you hold stock for a year or more, a year and a day, then you get to pay long-term capital gains rates, which fall in the 0, 15, and 20%. So ideally, you want to hold stocks for the long run, or if you do it like I do, you buy them and you hold them, and you never pay frickin' taxes on them because you're putting them in tax-advantaged accounts. Now, in this video, Seth has his investments inside, I believe it's an IRA, which means he's not going to pay any taxes when he reallocates his portfolio. That's fine. But if you're listening to this, you really need to be careful, because if you're following this strategy and you're doing it in a taxable brokerage account, you are not going to beat the market, because even if you wait for long-term capital gains rates, even paying a 15% tax at the federal level, and then whatever your freaking communist state charges you, when you stack those in and you factor in those tax rates, you're going to underperform the market in the long run. So let's keep watching a little bit more.
And so, yeah, I am surprised that here Turtle Beach is not on here anymore. That sucks. I love that. But so
Turtle Beach.
In my case, which I just found out from Mo, is in my case, I have my money in a rollover IRA, so that as far as I know, the tax code is different. I don't have to pay taxes because it's already paid, or it will be paid when I pull it out.
Exactly. If you have your money inside an IRA and you sell something and buy something else inside the IRA, you don't pay any taxes. That's why I always harp on put your money in tax advantage accounts, because let's say you have a massive gain and you pick a bunch of good stocks and then you sell them. Well, if that's in a taxable brokerage account, you're going to get your cheeks clapped by the government. But if it's in a tax advantage account, like an IRA, well, guess what? Zero taxes. Now, you either pay taxes on the front end or the back end for an IRA and your 401k, depending on whether it's a traditional or a Roth. I've made other videos about it, but they give you excellent tax advantages. So that's why I always crap on these other YouTubers that don't even talk about tax advantage investing, because they don't even understand it. I mean, Seth barely does, but at least he has people guiding him and helping him understand the tax implications, which are critical to your portfolio success.
And so if you're in a general brokerage account, what you would do, for example, if you were me, is prior to 1 year, you would sell the losses to write them off. The stocks that did.
So if you sell at a loss, if you have a gain and a loss, you can offset them against each other. That's kind of how they wash out. So if you decide to sell at a loss, you're not just completely losing it. You get a little bit of tax benefit from that.
Not get you any money. So for me, it was 2 or 3. And then you would, on your 1 year anniversary, you would sell off all your winners that you've held for a year. You would sell off all your winners, unless, of course, they stay on the list, and then you would just keep them on the list. So I think on this new list, Nate, over here, on this new list, there are at least 5.
All right. So, I mean, that's pretty much it for, watching that video. But the whole point of this, the whole point of why I'm talking to you about this right now is you can only try this if you want to follow their strategy, which is perfectly fine. I like this channel. I think they're fantastic, and I support them. But if you want to follow this strategy, you can only do it in a tax advantage account. If you're doing this in Robinhood Stock or any kind of taxable brokerage account, you're going to underperform the market in the long run. So if you have to invest outside of a tax advantage account, I would say just buy a broadly diversified ETF. I'm just going to buy VT once I make enough money to max my tax advantage accounts and invest outside of them, and just hold it for the long run, because every time you buy and sell, you pay taxes. Taxes, 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 taxes. Taxes, 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 taxes. All right? Very important. Anyway, that's it. Please subscribe to my channel. You can subscribe to Everything Money too. They're actually fantastic, but I think what Seth is doing is a little bit flawed for the average viewer. Maybe not for him because it's inside a tax advantage account. That's fine. But for the average person that doesn't have their money in a tax advantage account, you could potentially, or you probably will, underperform the market in the long run. All right? That's it, ladies and gentlemen.
5 or 7.
Have a delicious, superstitious, surreptitious day.